introducing our next speaker alongside Corey Sylvester, who's the principal of DXD, is Noah Spinger, who is the Executive Vice President and Chief Strategy and Partnership Officer at Extra Space Storage. Noah joined Extra Space Storage in 2006 after several years in the banking industry. His initial responsibility was to acquire the third-party managed contracts from the newly acquired Storage USA portfolio. Mr. Springer then helped create Management Plus Extra Storage's third-party management platform. Management Plus has become the sector's third largest third-party management portfolio and now has over 700 properties under management. In addition to overseeing Management Plus, Mr. Springer leads the asset management and construction efforts at Extra Space, which includes all value-add projects, commercial revenues, and joint ventures. Mr. Springer has a finance degree and an MBA from the University of Utah. So we'll go ahead and bring up Noah and Corey, and I will pass it again to you. And again, guys, we will get to all these questions afterwards. So Noah, nice to see you. Corey, off to you again. And we'll see you back here in a few.
All right. Get a mic on here and we'll get started. Noah, you're the man. Thank you for having us at these offices, and
thanks for coming out.
You know, you've always been a great guy in this industry, and it's, you know, just really thankful that you have us here. So thanks.
Oh, it's good. Not many visitors lately, so it's nice to have people out and people in Utah. Thanks for coming and joining us.
Yeah, I feel like we're in a fishbowl, having been some of the first visitors here at Extra Space. You know,
people are
they're seeing that. Who are these people?
Excited to see some different faces around.
Yeah, no, for sure. I'm all ready for the summer. All right. So one of the topics I want to jump into is, obviously I have, you know, an outsider's view on what's been going on with demand. You know, you guys obviously have a much more granular perspective. So, you know, the story I just told about self-storage really pivoting starting in March, and the demand we've seen and all-time high occupancies and pricing, you know, going crazy. What have you seen from a move-in perspective in terms of, like, why are people using it?
Yeah. Well, good question. I mean, look back a year. Look back a little longer than a year. Back at the beginning of 2020, and January, February, we were sitting in a spot that was interesting because there was a lot of development still coming on.
Right.
Everyone was developing. Every dentist had left their job pulling teeth and putting in fillings and started building storage.
Yep.
And there was so much building going on that was our primary concern,
Yep.
right? That was what everyone was talking about and what we were nervous about. Where we started then in the beginning of March, rentals plummeted. And honestly, we were scared, right?
Yeah.
And we had this data from back in the day in 2007, 8, 9, when there was a big recession, but this again felt very different.
Yeah.
And we literally shut doors and people couldn't come rent. Second 2 weeks of March and the first 2 weeks of April were scary.
Yeah.
And then in May and June, we really saw things change. And we saw our stores starting to utilize rentals online, doing the full online experience. We saw our stores open to more safe measures and a lot of people to come in. And we saw exactly what you said in your beginning portion, where people's lives changed. And depending on where you were, you know, everyone's lives changed, but people had different levels of it.
Mm-hmm.
You had to have kids that were taking school at home, and you had to put them somewhere to do that. You had to have people move their offices into their homes. And because of that, initially we thought, oh man, this might be where it falls apart. This might be where something bad happens. And it just continued to get better and better. June, July, August, continue to get better and better. And where we were so worried about development and a massive amount of development coming in January and February, that was all but taken away by June, July, August.
Right.
So it's been good. It's continued to be strong. Historically in storage, as we get through the summer months, as you go into September, October, you have less people moving and demand falling off. We didn't see that at all this fall. Yeah. And we didn't see it, you know, February is a slow month for us. This year it was not. And it continues to go well. And because occupancies are so good, that additional square footage that was built has leased up. Prices continue to be very strong. We continue to push rates over what we have historically.
Yeah, I mean, that was one of the crazy things that we were seeing in the data. back in the fall, and you know, some of the guys internally at DXD were tired of me sending out the charts. I even text them to you sometimes when I get bored. The seasonality that we normally see in the fall, which is that you see a fall off in demand, like you've always seen that. It's
Always
just
seen it.
always occurs, no matter what. Pricing falls.
Students go back to college. Those things
Exactly.
happen.
Mobility
We didn't have
goes
that this year.
down. You stop moving as much, and all you've seen is demand go up, and it's been one of the most extraordinary things to watch. I guess thinking about what could go wrong from that is when you have events like a hurricane,
Yeah.
right, where there's a massive temporary need for self storage. The same thing happens on the front end, right? Pricing and occupancies tend to go up. But then on the back end, you see very quickly that the move outs occur.
Sure.
Right? People have a temporary need and then they leave.
Sure.
Like, this is the big question I feel like in the industry is move outs are even below, even though move ins are above trend, move outs are below trend. So, this is a question.
When do the vacates happen?
Yeah. When did the vacates happen? Right. Get the point. When did the vacates happen?
I don't know. I mean, we have been thinking that's this whole time. Have thought, when do they happen? What's going to come up? Are we going to get to the fall and it happens? Well, students really didn't go back to school then. So what are we projecting? What did we budget? We looked at it and said, at some point, this probably happens a little bit. I don't think that it's going to happen in one shot. It's not going to be, all right, everybody got a COVID vaccine. Now everyone goes and moves out of storage. Yeah. I'm guessing the first thing that people think of when they think I got my vaccine and my states open up, they're not thinking, skip the vacation. Let's go clean out our storage unit. Yeah. Hasn't ever been said. Yeah. It's let's go do something that we've wanted to do for a while. Now, eventually, does that roll through? Probably. We're kind of projecting that, we could get to this fall and start to see that come back if students do move out. But I think it's a lot more muted than what we've seen historically. Yeah. Eventually, as they get there, it could. But right now, we're happy to take advantage of what we have.
Yeah, I guess it comes back to the question, really the question we need to answer is, what does the world look like as we move forward? And some people think that, I guess the question is there a hybrid world where we're living in going forward where I'm going to the office 3 days a week, but I'm still working from home 2 days a week? Because structurally what that does is that creates kind of permanent demand for a lot of those situations where I need to have a little bit more space in my home. The reason why I move that stuff out is not going away. Yeah. Right. So obviously, students that are stuff their stuff in storage last spring, that's temporary demand, will always be temporary demand. But I feel like there's still a good portion of this, and that's what we'll just have to wait and see. That is like sticky demand, right? I'm always going to need to work from home now. Maybe I don't go back to the gym for a couple of years. I'm going to continue to do my Peloton in my house. So that's the piece for me that I guess we're waiting to see. And we're 25% of the population's gotten some sort of vaccine at this point, and demand continues to go up. So it's not going to switch overnight, but that's the question. I guess we'll have to wait and see what's.
I think the other thing that you'll see, storage, as much as we're in it so much, we think of it all the time. It's still a relatively new asset class, right? This isn't multifamily. It's not office. I mean, storage is fairly new, right? In the late 70s, this is when all this started. So the product type and the consumer is still being educated a little bit. And there are a lot of people that still haven't used storage. Right. And now a lot more people have. And so where before, when I started in 2005, 2006 at Extra Space, it was around 9 square feet per person. It was kind of that industry average as to what's being used. Now it's more like 13, right? Could we get up to 14, 15, 20, right? Of people that are using storage. And so if we get to those points and people are just more familiar with it, and instead of using their bedroom for storage, they're actually using it for an office or something else, then it might continue in that regard. And people are just more used to it, right? Yeah. The same way that, if we would have said 5 or 10 years ago, hey, you don't need a rental car, you can just go jump in some stranger's car and they'll take you where you want to go, or sleep in an extra bedroom of a house in a city you don't know on Airbnb, people have thought we were crazy. Right. Well, now does storage become more normalized and people just kind of use it more because they're used to it.
Right. So even though we've seen pricing accelerate in, call it, most of the markets, there have been restrictions similar to what happened during hurricanes, where prices, like in California, you can restrict how much prices can go up. And some of those restrictions are still in place. I guess, how do you think about, how much of the country is still under that sort of mandate? Obviously, the industry's still done well even with it, but how does that impact your business? And, generally speaking, are there ways that you can continue to generate revenue growth even when those kind of mandates are in place?
Yeah. So something very unique about storage, and in the early days of storage, people were nervous about it.
Yeah.
Is that you have people on a month-to-month lease, and you talk to banks that aren't really educated in storage, and they would say, "What happens when everyone moves out?" Right? Well, that never really happens. The bad of that is, I guess, everybody could move out, but that doesn't happen. The good of that is we can increase people's rates. So Extra Space really pioneered this a long time ago, these existing customer rate increases. And every 6 months after someone moves in, and then kind of 9 months after, we give these rate increases. And they've averaged 9 to 10%. We're finding that we can increase those even more during a very high occupancy time. But in areas where there are these emergency restrictions, we can't do it, right?
Yeah.
And the law mandates you can only have so much from where someone moved in. And this has happened. It isn't unique. It's happened during hurricanes. It's happened in California during the fires a couple of years ago. And
Right.
so we have to make sure we follow all those laws and those rules. Does it hurt a little bit? Yeah, we're still getting people in at good rates, and then we're moving them as much as we can. But it's important that we follow those laws, and we can't go beyond what we can do. So,
Right.
what do? We do the best we can, right? I mean, government restrictions are kind of a thing that everyone has to deal with in every aspect of the business. We'll have to just kind of go with that. So,
Right. Yeah, that makes sense.
and hopefully we can continue to increase occupancy and get those kind of levers. That's the best we can do.
Yeah. So I'll go back to one piece about kind of the penetration that you were talking about. And if we look at, actually, there's a chart we have here. It's the last chart. So utilization of self-storage, a lot of people refer to it, but it's like essentially, you talked about storage being a new product. So utilization, the way we think about it is what percentage of the population is using self-storage. And if we look at the chart, essentially there's been a 50% increase in the demand for self-storage over the last 15 years. Like, help me understand how you guys think about where that could go. Do you have any sort of way of structurally kind of thinking about like how high it can go, other industries that maybe you've paralleled to think about like what that is, or how do you guys think about that?
That's a good question. I don't know.
Yeah.
I mean, so far it's only gone one direction, which has been very positive for all of us, and we're happy for that. I think it's an education and maturing of the customer as well as the product type. Back in the day, people would look at storage and kind of think, "Oh man, this is a seedy product, right?
Yeah.
It's some guy sitting in his El Camino, looking over his shoulder with a shotgun, saying, 'Yeah, put your stuff over here in my back 40.'" And that's not necessarily what we have anymore. The buildings that you see now are beautiful buildings, and they're fully climate controlled, and they have alarms, and they're great looking assets.
Right.
And as the customer understands that, they kind of look at it and say, "Yeah, that's something that I can use." And I can see my wife going down and getting that for our Christmas decorations, whatever the case is.
Right.
I also think the other important thing is to look at storage. You can't say it's ubiquitous across all groups. In Texas, they use storage very differently than they use it in New York or Florida or DC, right? And in Texas, they're putting four-wheelers and boats in there, and in New York, they're putting blenders and Christmas trees in there. So it's a very different type of thing. Thus, your unit mix is different, and things change. So in areas, I think you're going to see utilization continue to go much higher. And in some spots, maybe because people are so used to it, it kind of stays a little more flat. But
yeah,
it's gone well and continues to go well.
Yeah, it's a difficult question. I mean, who knows? But one of the things you just tipped on is the difference in demand relative to where you're talking about. In Texas, you don't have homes that are really built with basements. In the Northeast, there are a lot of homes that are built with basements. So the structural demand can vary a lot from area to area. One of the ways that some of the industry will underwrite is thinking about, well, I want to put new supply in an area where there's low square feet per capita.
Mm-hmm.
I guess the question to you is we don't tend to think that way. I think price is set almost every single night. It's set every single night. So that's your best indicator. Like at a given location, that's the supply and demand balance. When you guys are having decisions around adding new capacity, you don't really build, but in terms of like adding an expansion, is it what's the square feet per capita here, or what are the rates?
Yeah, so we'll look at square foot per capita, but it's kind of like it's a metric, right? It's one thing to look at. If you look at New York, you could say that 2 square feet per person, you can build forever, but you can't really. I'm more concerned about how much was added in the last little while that's continuing to lease up that we have to be worried about. So you might in New York go from 2 to 3. Oh, that's a 50% increase.
Right.
And that's a huge amount of square footage that you have to lease up. You just happen to have a lot of people around there. It would make me nervous to add that much into it, right?
Exactly.
Now, if you look at what can be leased up, we look at our own stores and we look at our rates and we look at our stores and say, how are those stores trending? What are the stores' occupancies? How are those holding? Are there certain unit types that are renting over other ones? And how can we configure those things based on that? So if that's for ourselves or for someone that we third-party manage from, they contact us and say, we're looking at doing this store here, 200,000 square feet at one property that maybe has another 400,000 square feet coming, it's going to hurt, right? So it's very localized and it depends on that store in that area. So square foot per person, it's a metric. It's not everything by any means.
Yeah, that's what I was pushing for. It's technology. So obviously, like the hands-off approach you've had to take to doing business over the last year has changed pretty dramatically.
Yeah.
And I think the debate prior to COVID was, well, a manager creates a ton of value because they're really a salesperson, right?
Sure.
The customer comes in the door, you sell them a closer proximity unit, you sell them tenant insurance, there's an upsell there. So there's a value being created by that person. So there was just as much of an argument, I think, to be made against automation as there was, for, automating the rental process and keyless locks and all that other stuff that allowed you to basically remove personnel from the cost line. Obviously, the last 12 months has changed the perspective on automation because now there's a kind of a structural need for it. How do you guys envision automation rolling out? Because I think obviously you guys have got really high quality people in your stores that do add a lot of value. So where's that balance going to come for you in terms of driving, an automation and touchless approach versus still maintaining that store manager that creates a lot of value?
Yeah, good question. Again, I'd probably look backwards a little bit. If you took 15 or 20 years ago, our store manager did a lot more than they do now. They would sometimes set rates. They could look at things and say, oh, we shouldn't give Sally a rate increase because this reason that she has, right? And so we shouldn't do that. They would go out and do marketing and hang up door flyers and do those kind of things. Now we really specialized a lot of those jobs, and our revenue management team, that's PhDs in math and statistics are doing all the revenue management, and our marketing teams are doing all the internet marketing. We kind of taken that away from store managers. So the job has definitely modified. Even 20 years ago, you had a lot of people that were living at the store. It was a couple, and the one of the people of the couple was renting units and one was cleaning up the facility. Rarely do we do that anymore. So the role has continued to evolve. Right now, we've looked at it and said the best thing we can do is have that manager rent units and have it be a retail feel and be a good salesperson. They don't need to worry about rates. They don't need to worry about marketing. Rent that unit for that person that got into that facility right there. Now, in the last year, a lot of it's been much more over the internet and coming in and I have a unit rented and they can go do that without even seeing the manager. Our goal is to be able to get to the customer the best way the customer wants to get to us. If they want to walk in and talk to someone, then they can do that right now. If they want to do everything touchless and online, they can do that too. Over time, it probably goes more and more to that. But at our stores where you might save a couple bucks in payroll relative to one rental, it makes no sense to pull that person out and say, what happens to that lost job if you lose 2 rentals because of that? You might as well have had that person, right? So while you can reduce some cost on salary, if you lose a couple rentals because of it, it wasn't worth it. What I think we'll probably see is at smaller stores or lower rent per square foot stores, we can augment hours with online rentals.
Okay.
We're closed on Sundays at all of our stores. We have a handful of more urban locations that are open, but for the most part, we're closed on Sundays. Our Sunday stores can rent online now. Our stores that are closed on Sunday can rent online now. And so that's a way that we can look at it and say, yeah, it's already being utilized when we're not there. We have some stores that will say, you know, they weren't getting a lot of rentals on Thursday. And so let's just do online rentals there. And so we can utilize that, but I don't foresee a day when it's just completely managerless, fully get rid of them. Now they're still very valuable and really help that customer a lot.
Right. So there really isn't going to be, I mean, on the smaller facilities or maybe the less accretive markets, maybe there's some cost savings that you can create by automating. But generally speaking, like this vision of automation creating, you know, another wave of like cost savings in the OpEx line doesn't really pan out in that way. It kind of creates more convenience for the customer and a better experience, but not necessarily changing the cost structure of storage.
Yeah, I mean, again, if you look at a store in Oklahoma, where your cost structure might be very different than a store in San Francisco.
Yeah.
And you might be getting $10 a foot or $30 a foot. That payroll, it helps a lot more to have less at the store that's only collecting $10 a foot.
Right. Your opportunity cost is a lot less.
Right.
Yeah.
So if we can make some modifications there, we'll definitely try that. But I still think it's for the foreseeable future, we still need our managers, and they're still a super important, vital part of our business.
Right. Well, one of the things you touched on was the marketing costs. So when, you know, stepping back, when I first got into this industry in like 2015, 2016, one of the things I was researching was, you know, the cost of acquisition, which is essentially, you know, a bigger percentage of people now are going onto the internet and
Yep.
they're renting online. So your ability to capture them online means you got to pay Google,
Yep.
right? And so the kind of the average cost to capture the customer that you actually get in the door, when all this new supply came on in 2016, you know, from what I gathered, there was a large increase in that cost because all of a sudden you have a lot of new supply coming online. Everybody's basically going for the same customers. They're all having to pay a lot more. What has kind of happened since then? If I kind of go, you know, obviously the demand, the supply has been alleviated, but how have marketing costs changed since, you know, kind of that peak in 2017, 18, 19? What's been going on in terms of the cost of going to Google?
So if you go backwards, and storage takes some time to get through because maybe we're a little bit of a backwards industry and not necessarily the most technologically advanced historically industry. We were still doing, you know, a lot of people were still doing yellow page ads in 2008, 9, 10, right? Yeah. At this point, if you're in yellow page ads, you got major issues.
Problems,
You know, my kids asked one time, they're like, hey, I understand what Facebook is, but what's a phone book? I don't even know what the thing is. So once we kind of got through that in 2010, 11, 12, and the supply started coming, all the supply at least was available, everybody was bidding. Yep. And as everyone knows, you bid on one keyword, self-storage Tampa, self-storage Denver, and everybody's going after that customer. It just made it pricier and pricier for every single person. Now, relative to your total cost to your facility, the marketing spend isn't that much. And so everyone was really going after that and spending a lot. You saw those costs increase substantially. We were seeing annual 30%, 40% increases on Google pay-per-click costs.
Right.
Since all of that's gotten leased up and there's just less square footage available, we've been able to ratchet that down substantially for ourselves and for our managed partners. Hopefully we can continue to do that. The other thing that Extra Space has done is said, let's not just be fully reliant on pay-per-click. Let's really start building out our search engine optimization.
Yeah.
And instead of just having one lever over here with Google, what can we do to modify this that we're really building up our SEO way more? And so we've shifted and allocated budget into that a lot more this year. And where we could have seen maybe more savings on marketing, we put a lot of it into that so that it pays off dividends in the future. Hopefully that'll continue to go forward.
Right. I mean, that was where I was going with the next question, was really, you know, with that dependency on Google, you're vulnerable in these supply cycles where you have a lot of new stores that are opening up.
Yeah.
So are you ever really able to transition a lot of people off of the Google, or how do you think about like the viability of building SEO through other measures? I mean, is it just organically helping your ranking, or is there actually other channels that you think you can
I mean,
bring in customers?
Google's a monster,
Yeah.
right? And nobody's getting away from Google.
Yeah.
Whoever you are, whatever business you're in, storage or not storage, right? If you're selling whatever you're selling, you're bidding on Google.
Yep.
At some point, we'll probably always beholden to them because they can just drive serious traffic.
Yep.
Also, the metrics are really good and the data is really good. We can look at it and say, what's an ROI on this customer in this area at this place and at this time, and go after that specific customer instead of taking pamphlets and putting them out in the neighborhood and hoping. You know exactly what you're going to get. And so it's a good customer.
Right.
The cost of that customer is going down, right? Where with Yellow Pages a long time ago, it could be $1,000, right? $800, $900 per customer that was coming in that we're paying. We are much less than that now.
Yeah.
And so
That's crazy. I didn't know it was that much.
it was extremely expensive because you're just taking an ad and putting an ad in and hoping that someone finds you in the Yellow Pages. With Google, it's still a very good tool. We just don't want to be as reliant on it as we always have been. Now, doing SEO, doing pay-per-click also helps your SEO. You can't just say, all right, bag this and focus on this. SEO is going to hurt as well. So we're going to continue to do both. But a majority of our spend is going to continue to pay-per-click.
Yeah.
But we'll continue to try to build that up.
All right. Well, let's jump into some questions here. Let's see what we got. All right, so we had one question, which was, what explains the seasonality of rates, which I think we went into a little bit, but essentially the idea is that, moving, buying homes, a lot of this occurs with a higher velocity or higher frequency in the summer. That increases the demand for storage in the winter. There's just fewer of those type of life events that typically need storage. So you tend to see those big kind of bell curve rates. Correct me if I'm wrong with that.
Yeah, no, I totally agree. And at a store, as you lease a store up and it becomes more and more occupied, you can continue to push rate because there's less availability. You have some churn at a store. And so a store will, it starts out at 0%. You can't pre-lease storage. Storage is a need-based business. It's like looking at something like a coffin, right? If you're a coffin salesman, it's really hard to sell that. If I come in and say, hey, Corey, I'll sell you a coffin for half off. You're like, I don't need that today, right? Maybe way down the road.
I'd have to buy storage in order to keep it.
Exactly, right? So you can't really sell those things until someone needs it. Besides you and me and a few other people, nobody wakes up in the morning excited to go rent storage. But when they need it, they really need it.
Yeah.
Right. And so when someone goes and gets it and they need it and they stay there, what happens is that facility continues to lease up. The churn at the beginning is pretty dramatic. And then once you get to that store at 90, 95% occupied, there's less churn and you have more long-term tenant bases. And even on that long-term tenant base, we continue to increase their rates every 9 months or so. And it continues to go up. So an older store inherently is more valuable. There's more higher cash flow at it than a younger store because that long-term tenant base that just stays there.
Yeah, I mean that's one of the things that I think about a lot, and I think is lost a little bit. But say in year one you open your store and you get to stabilized occupancy after 3 years, and if you were to look back, maybe 15% of those tenants or whatever the number is are long-term tenants. But over time, the composition of the tenants in your facility continues to creep higher in terms of the number of people that are staying there on a long-term basis. And so what it's effectively happening is the number of available units in that facility is kind of structurally shrinking over time.
Right.
So like when you open a self-storage facility, it's physically stabilized. That facility is naturally kind of effectively shrinking over time because a lot of those people are moving in and they're never moving out.
Yeah.
So the units that are available for rent, the number is shrinking. So that's one of the things I love about storage is that you've got this dynamic of supply shrinking naturally over time, and we're in secular growth. So just as long as you don't have, 3 facilities opening up next to you,
That's right.
if you pick the right location, you can do really well.
Yeah. It's the good and bad. At some point you're full and there's no bread on the shelves to sell,
Right.
right? And you want to be able to increase that. Hopefully you have some way you can expand your facility or do something. But yeah, that's the good thing of it too, is that that facility continues to get more and more valuable because those long-term tenants.
Exactly. All right. Was oversupply nationwide or concentrated in specific markets?
Well, it's a good question. It's kind of like the question of if was the depression nationwide thing? Well, if you lost your job, it's super important,
Yeah.
right? And if your neighbor lost a job, it's pretty important. Storage is very localized, and most of our tenants for one facility come between a 3 to 5 mile radius. And so if you have a store that's being built across the street, it's gonna hurt. It isn't just based on the averages across the nation, but where we saw it in all the development cycle in the last few years was really in major metro areas, having that built out. Denver had a lot come in. New York had a lot come in. Portland had a lot. Tampa had a lot come in. And so a lot of those areas, and where a lot of people did really well, were in the areas that historically we'd say, does it make sense to be there? And it makes me a little nervous, right? If you're in more secondary or tertiary markets, Wichita didn't see a lot of building until just recently, but they did really well because everyone was focused on Denver and Tampa. Nobody looked at those other areas. So people always ask, where should I go build? The answer is where everybody else isn't.
Yeah, go where people aren't. I mean, that's the dynamic that may or may not be lost on people, but the one of the good and bad things is obviously you can look at it from a national perspective. Rates have been declining on average because supply has been added, but that doesn't mean there aren't really incredible projects that you can't find, because you're talking about a 3 to 4 to 5 mile radius that to the degree that demand has continued to go higher and supply hasn't been added. All you got to be able to do is find those locations, get the entitlements, make sure that there's enough barriers so that someone can't do the same thing behind you. And depending on which market you're in, that can be an easy or a hard thing. And that's how you create value.
If you have the data, if you have a good developer, if you have someone can entitle good dirt that's hard to get, those stores are very valuable, right?
Okay. Is demand generated from homeowners or renters? What about the new trends towards renting single family homes? I'll say one stat that I know from my background is that renters have a 3 times roughly higher propensity to use self-storage because of their increased mobility than single family home dwellers. But how would you think about, obviously some of the areas that you build self-storage, there's just a lot of single family homes around there. So obviously,
really we're looking for more population than anything, right? Higher population usually translates to easier to rent facilities. Renters help, right? It's a good thing, but I wouldn't just base it just on that.
Yeah.
So yeah, it's a nice thing, not a have to have thing.
Right. So you're just looking for density of customers, not necessarily the composition of whether they're renters or single family renters. Okay. Percentage of storage used by commercial customers, and whether commercial use has changed positive or negative through COVID.
Yeah, it's a good question. And it's actually something we're studying right now, and I need more time to answer that better. So we've looked at it and said, there's got to be something else better here. The funny thing is, as people go rent, we just haven't tracked it very well. The industry hasn't done a great job of tracking it very well. And I could give you an answer, but I feel like the answer isn't well vetted in motion. And so it's still being looked at to say, what's the right number?
Fair enough. The U.S. government stimulated the economy with direct checks to taxpayers. When stimulus ends, does it affect self-storage demand?
Kind of goes back to that same thing. When do the vacates happen?
Yeah.
Right? I don't know.
And to what degree?
And to what degree? I'm not sure. Hopefully, by the time that stimulus checks end, the vaccines are out, economy is going, jobs are coming back, restaurants are going, and so people are out and doing. We haven't seen it where before the stimulus checks came out, it wasn't like people were saying, oh man, I'm getting rid of my storage unit because I don't have enough money.
Yeah.
You gotta remember, average check size for this every month is 100, 110 bucks. So it isn't something that, people kind of pause on paying mortgages or rent sometimes, where it was $1,000 or $2,000 or $5,000, but $100, $120 for storage was something they continued to pay.
Right. Don't want to throw out my yearbooks. All right. So is there consolidation happening in the industry? I'll let you.
Yeah, there's continued consolidation industry, but builders continue to outpace what we're able to consolidate. We are buying, we are managing a lot of stores. We're bringing on, as far as acquisitions are concerned, we're buying between 500 to billion dollars worth of self-storage every year, and we're managing between, on average, probably about 150 stores we bring onto our platform. So there's definitely consolidation between kind of the big players, but developers are continuing to do more than we can bring on. So while it's still expanding, it's also consolidating at the same time.
Right. Okay. How do you practically prevent oversupply in a market? I'll let you start with that one.
Well, I guess the answer is,
That's a tough one.
yeah, but it's really based on what the return is,
Yeah.
right? So if you can build to a 9 and sell at a 6, there's going to continue to be building, right? As that shrinks because occupancies take longer to lease up or rates come down, and now you're building to a 7 and you can sell at a 6 or a 6.5, whatever the case is, you're going to see less building. And so it's based on what the investment is going to do.
Right.
Now that's smart building, right? Sometimes you have people that do stuff and just
I can
do it.
I can make a 9 in my model pretty easily.
A lot of people can make a 9. Yeah, that's the issue, right? And at some point, you look at some of these markets and say they weren't building to a 9. They thought they're building to a 9, and it really was a 7.
Yeah.
And they can sell for a 6.5, and that's not enough spread on a development to
really
get
do it.
there.
I think there's just a lot of intellectual honesty on the part of the developer around how much of a barrier is there really. I mean, to the extent you have you have to battle a FAR with the city that takes 18 months, that's an entitlement. That's a true entitlement barrier to entry. To the extent it's zoned for storage and all the specs of what you're trying to build are in line with what the city says is allowed, then there's not a lot of barriers there, because to the extent that you found a viable piece of land that you could build, then someone else can. So I think, like, as you really make that decision of, am I building in a market where there are true barriers to entry, it really has a lot to do with, well, how hard was it for you to build? In what areas around you are there those similar situations, or are you in an area where it takes 18 to 24 months? And that in and of itself, time for a developer, a lot of developers don't want to waste time and money because you have capital at risk and time at risk. And that's really where, you create value, to the extent that you really get into a market. Like LA definitely did not see the boom that you saw through the rest of the cycle. The reason being is because if you're within 500 feet of a residential house, you have to go through a massive entitlement process, and you're not guaranteed that you get that. So, making sure that you're picking those sites, I think, that have the right balance of those structural impediments, because if they're too high, you can't build there, and that is what it is. But anyways, that's how
the harder it is, the better it is.
Exactly. Self-storage is very localized in a commodity. How do you differentiate new facilities from existing supply?
Yeah.
I mean, I'll say that, a lot of the self-storage that's out there is really old, right? It's really old, drive-up doors, non-climate controlled. Like the secular shift that you're seeing is, like, in one of our entitlement battles, the city councilwoman got up and misspoke, saying that we're building a medical office building, which, if you look at the building, not knowing itself, it looks like a medical office building, right? So the product itself is undergoing a transformation. So, to the extent that the guy next to you has a drive up non-climate, and you're able to pull your car inside, close the garage, It's climate controlled. You wheel it up in a well-lit, high security elevator in a new building. Like, that's differentiation. Now, I struggle with, are they realizing that at the time of booking?
Yeah.
And that's where it becomes more difficult to do that. But once they drive up to it, I guess that's
At the end of the day, it's a garage door and a light bulb and a space, right? And so, yeah, it's a commodity. Now, the hard part is, can you find that customer, right? Can you go out there and get them? Can you bring them to your facility? And that's what I think the Extra Space and other bigger players have figured out a lot better, is how do you dominate the customer experience and finding them to get them to your store, right? Now, the store has to have certain table stakes. It's got to be well lit. It's got to be clean. The manager has to be decent, those kind of things. So you have to have those things, number one. Then you have to be able to have enough of an online presence to get somebody there. You might have the best restaurant in the world, and you would say, well, food's a commodity, right? You can differentiate a little bit, but if you can't let people know where you are, it doesn't really matter.
Right.
So you have to have a good location. Real estate matters. Your online presence matters. Manager is a piece of that. Your price is a big piece of that, right? If you're looking at a store and saying, oh yeah, it's $10 cheaper over here, that might mess you up, right? You want to make sure you get that customer. It might be better to be cheaper, bring that customer in, and then increase the rates on the back end. So
Exactly.
there's a lot of things there that go into it that, while it's a commodity product, there's a lot of stuff that it takes to get someone there to do that.
Right. Okay. I think we have time for maybe one more. I'll give Extra Space let's see, what separates Extra Space from the other REITs or larger operators?
We're just way better.
That's it.
I think that some of the big things is, we've done a lot of stuff, and depends on who's asking and what the question is, right? If you're an investor and you're looking and saying what's better, the stock performance has been one of the best in the sectors by far. What we've done with our total shareholder return has been phenomenal. If you're looking at it from an employer standpoint, the culture and values and what Extra Space is a great company, and a great company to work for and to be with, and to be a part of. If you're looking at it from a management standpoint and have someone run our store, I think it's our ability to treat our partners like partners, right? We call the people that we manage for partners because we learn a lot from them, and we take a lot of what they do and mix it into our mix and say, hey, this is how we should run the store best. We don't differentiate between our owned stores and our managed stores or our joint venture stores. Everything is an Extra Space. And it's fun too. If you go to our stores and you ask a manager, a lot of those managers don't know or care who owns it. If Extra Space owns it, if you own it, if Prudential owns it, they're going to look at it and they're going to say, I don't care whose this is. This is my store, and I run my store, and I keep my store clean, and I keep my store leased up. And that's an important part of the culture at Extra Space.
Right. Here's one question I had just thinking about it was, so Extra Space used to be in the development game, but got out of the development game. Obviously, you guys have got so much data and potential competitive advantage to the extent that you wanted to do that.
Sure.
What do those conversations sound like about why you shouldn't be developing? So you're redeveloping some of your stuff in terms of adding capacity and things of that nature, but why wouldn't you be a developer?
We used to do it for a long time. The reason why we got out of it is because when everything got really hard in 2008 and 2009, we were trying to refinance a bunch of loans, and we had a lot of CMBS debt. And when that CMBS debt was peeling off and there was nowhere to replace it, no CMBS market after that, we looked at it and said, we have to replace all these loans, and there's no CMBS market to put it into.
A lot of business risk.
So we went out and retooled and recapitalized to put those loans into other types of loans instead of the CMBS market. And at the time, it was really hard to sell, we need to replace these loans, and at the same time say, and we need a new loan for a new store that's being built, right? Much easier just to say, we need to replace this one. So at that point, we decided, all right, we're gonna stop development. And then once we did that, we realized we can grow a lot better through and with our partners that are going out and building stores. We can either acquire from them, or maybe we can do joint ventures with them, or certificate of occupancy deals with them, because it's hard. It's hard for us in Salt Lake City to sit here and feel like a local developer in Dallas or Houston or Orlando or wherever else in the United States. The guys that get the best deals are the ones that are local to their market. They're playing in their backyard. They can go find stores. They have the data. They know the people on the cities and on the boards to be able to say, yeah, we'll get this one approved. And we're sitting here trying to pretend ourselves we're better than them is really hard to do. So that's kind of why we said, it doesn't really make sense for us to do this. We'll work with our partners to grow, but us having our own full development team to go out and do that, take land risk and buy those, probably not doing that right now. Now, that doesn't mean we wouldn't do it in the future or do it in some small capacities, but I think it's a lot better to allow our partners to kind of push that.
Right. Okay, I like that. Let's see, we have anything else? We'll do one more with, have delinquency rates gone up through the pandemic? And has that changed as lockdowns have lifted?
Yeah, they have. We've seen it. We saw a lot at the beginning, but it was really hard to tell because we had to pause all of our auctions.
Okay.
So as certain states or jurisdictions went into lockdowns, we've had to say, okay, New York City, they were very strict, right, on kicking people out. Typically with our business, if someone doesn't pay, you have all of their stuff and you can overlock the unit. And then you work with the customer and say, hey, you haven't paid, you want your stuff back, let's figure out some deal. Or eventually we auction them off if we can't get a hold of them. If they don't pay, they say, okay, fine, take it.
Yep.
We'll auction that unit off. It takes some time. During the pandemic, all the auctions were paused during the pandemic, and still in some areas and jurisdictions, late fees are paused.
Still paused?
And, not any more auctions,
Oh.
but the late fees and that in some areas. So we did see that go up substantially because we put them into more delinquent status because we weren't auctioning things off. As we pushed that through and got that done, and it took us some time, just kind of pushing a rat through a snake. And once we got that done,
Right.
we've gotten our delinquencies down to more normal, acceptable levels as to where they are now.
Right. All right. One thing I don't want to stop without saying was, during the pandemic or during the last 12 months, there's been a lot of like big name people getting into self-storage from an investment standpoint. Bill Gates bought a stake in a private operator. Blackstone bought Simply Self-Storage. I think the net result is certainly it was evident prior to the pandemic, but the pandemic has exacerbated the reality of like it's just a really stable cash flow, and hotels and some of these other things that people were really excited about. People have realized that cash flow maybe isn't as stable. So with the fact that now you've got, Singapore sovereign wealth fund, Bill Gates, Blackstone throwing capital into it, how does that complicate, I guess, what's going on with the market from terms of like demand for existing cash flowing facilities? Does that make it harder to grow? And, what is your outlook on kind of where cap rates go?
Number one, it's expensive now, right? It's gotten more expensive and it continues to get more expensive. The stuff coming on the market is pricey, and sellers are expecting to get paid. Right? For a long time, we didn't see big money coming into the space because it's really hard to do. You're really writing pretty small checks relative to other asset classes, and it takes a long time to put together a large enough portfolio that's sizable that Bill Gates or others care about. Right? Them writing a few $100,000 for one facility check, it's not very exciting to them. No. $1 million or $2 or $10 million a lot of times isn't enough. This needs to be hundreds of millions. And so as those deals have come up, we've seen bigger entrants in the market. It's made it more difficult for us to buy, right? And it's made it harder for us to do. The flip side of that is it's also made our company more valuable. It's made other opportunities. Our stock has done better because of that, because more people are looking at that.
Right.
Where do cap rates go? I think that if something happens with interest rates, that'll make a modification. As of right now, they're probably gonna be low, and they're probably gonna stay low. I don't see many changes saying, "Are we gonna see a big shift and go the other way?"
Yeah, I mean, I think rates are staying low forever, but
I don't know. We're gonna say forever, but I'd say it's for a long time. People have always said
the government to finance all this
it's going the
debt
other way.
without all these interest rates going up. But anyways, yeah. All right. I think we should end it there. Noah, thank you so much.
No problem. Thanks for having us
here, taking the time.
Yeah, thanks for coming out.
Thank you very much for for spending the time to talk with us.
Absolutely. Thank you.
And that's it. Thanks everyone for joining us.
Thanks, guys.